Investment is the process of using money or resources today with the expectation of getting future benefits, usually in the form of profit or income. This means we put our money into something now so it can grow in the future. Examples of investment include buying shares, bond, property, or other financial instruments. People invest for many reasons. First, to grow their wealth and increase the value of their money over time. Second, to achieve future financial goals such as education, buying a house or car, or starting a business. Third, to prepare for long-term needs like retirement. And finally, people invest to beat inflation and maintain their purchasing power.
Type of investor. First, risk averse, which is these investors are very careful. They prefer safe investment and want to avoid a big loss. If something has higher risk, they will only consider if the return is worth it. And the next one is risk neutral, which is they are more balanced. They don't avoid risk completely, but they also don't chase high risk. As long as they get back what they invest, they are satisfied. And the last one is risk taker. These investors are comfortable with high risk. They believe that taking bigger risk can lead to better opportunities. Next, risk and return. Risk means the result of investment may be different from what you expect. Meanwhile, return is the actual outcome, which is it can be a profit or a loss. So, risk and return are usually moved together. If the investment is safer, the return is normally lower. If the investment is riskier, it has a chance to give a higher return, but it is not a guarantee. So investors must choose a risk level that matches their comforts and goals.
We will explore the securities market and how it supports the investment process. So what are securities market? Securities markets are places where people buy and sell shares, bonds, and other financial products. They help companies get money and allow investors to invest safely and easily. There are two types of security market. The first one is primary market and the second one is secondary market. First one is a primary market, which is where a company sells its shares or bonds for the very first time to raise funds for business growth, and investors buy directly from the company. A common example is an IPO, where a company goes public and offers its shares to investors for the very first time. The second one is the secondary market, where investors buy and sell existing shares from each other, not from the company. It provides liquidity, meaning you can easily sell or buy your investment. An example is Bursa Malaysia, which is the main stock exchange in Malaysia, where this trade
And now we
takes
continue
place.
my part, which is flow of funds in the economy and benefits of the securities market. Flow of funds means the money moving from savers to borrower, and it helps to business growth, job creation, and the economy. First, we start with savers, mainly household. These are people who have extra income. Instead of keeping their money idle, they put it into banks, stock markets, bond markets, unit trusts, or retirement funds. All the savings become a pool of funds that can be used in the economy. For the borrower, it means that a borrower who doesn't have money, so they go to bank and they will borrow the money and they will use it as their expenses or their daily routine, daily use. With the benefit of securities, we can say that it helps securities market help people and organizations raise and use capital.
And the last part, once a person understands their growth and risk tolerance, the next step is to identify the type of assets available for the investment. The category investment of assets in two main groups, either real assets or the financial assets. Real assets refer to the physical resources with the interesting values such as the property, land, or goods. They are tangible and can be used in the real world. Meanwhile, the financial assets are the non-physical instruments like the stock, bonds, unit trusts, and the deposit. This value comes from the financial market rather than the physical form. Example, shares for company ownership, bonds when the lending money to the government or company, unit trust and the mutual funds, and also fixed deposit and insurance investment plan. We are compare the real asset and financial assets to help the investor discover which type suits their personal preference. The first one, real assets are tangible and it usually more stable but it have the lower liquidity. This means that they are harder to sell quickly, but it provides a steady, long-term income such as the rental or appreciations. Other than that, the financial assets are referred to intangible, but it's very liquidity. It can be bought or sold easily in financial market. These assets often carry higher market risk, but it also offers the attractive returns through interest, dividend, and price change. Regarding the type of the assets, the investor can evaluate each asset based on the risk, liquidity, and return. Regarding the real assets, it generally carry moderate risk with stable and long-term growth. However, it have a less liquidity because it takes a longer to convert into cash. More financial assets are depending on the types. It also can be ranged from the lower to the higher risk. It offers much higher liquidity that ensure the investor to make suitable either short-term or the long-term investing. And the last one, the return can be very competitiveness, especially in strong market conditions.